listening to the Financial Lens episode titled Income Strategies for Retirees. The impetus for this program is a Wall Street Journal article. This is from the April 7th publication titled Stocks Haven't Looked This Ugly in Years. Measures of shares appeal to bonds is at its lowest level since 2007. The reward for owning stocks over bonds hasn't been this slim since before the 2008 financial crisis. The equity risk premium, the gap between the S&P 500's earning yield and that of 10-year treasuries, sits around 1.59 percentage points, a low not seen since 2007. What this article is talking about is how the earnings of stocks compared to bonds for investors who are looking for income. And this is particularly of importance for retirees who are no longer earning an income from employment and need their assets to make up their difference between maybe their Social Security and pension needs and their spending velocity. So when you look at an investment allocation approach, as I call it, you have really a few ways to generate your cash flow. The most popular, the most common are stocks and bonds. Of course, you can have different type of investments. You can have real estate investment trusts. You can have limited partnerships, many different strategies. But stocks and bonds are primarily viewed as the most common. And there are two ways to use these vehicles for income. One is to purchase bonds, and bonds are really loans that are taken out by corporations, municipalities, and the way they work is investor purchases a bond, gets a stipulated interest over a period of time, and after that period of time has lapsed, they receive their investment back. Stocks, of course, are ownership in companies. The reason investors own stocks may be for their overall return, how much profits they get, and of course the increase in the value of the stock. But there are some folks who own stocks for the dividends. And this article looks at those two different strategies and compares them. And what has happened at this time is that the return for stocks is less attractive than bonds since 2008. Now, I'm going to be a little more specific what I mean by that. They're talking about the yield, which is the earnings divided by the value of the stock. So when you look at the earnings yield, you're looking at how much profits it's generating compared to its price. Now, when the stocks are earning more money, their yields are more attractive. When their price is down, they're also more attractive because the relationship between the earnings and the price is what we're looking at. So we compare that to the 10-year treasury. Now, the 10-year treasury is up significantly over the last year. Profits are down and valuations are pretty high. So that combination of relatively low profits, relatively high price of stocks, higher 10-year treasury rates made the stocks less attractive than bonds for income. There's another approach to earning income. I call it the disposition allocation approach. And with the disposition allocation approach, what you do is you look at specific financial vehicles that will get you the specific objectives that you're looking for. So if you're looking for income with a disposition allocation approach, you'd be looking for vehicles that specifically provide income. And if you're looking for guaranteed lifetime income, you may be interested in lifetime guaranteed income annuities. So those are two different approaches, the investment allocation approach and the disposition allocation approach. You can read about both of those in some detail in my book, Maximizing Your Retirement. But I also want to talk about another strategy and how we really should maybe be looking at stocks in this current marketplace. When we look at what I call a timeline investment strategy, what we want to do, we want to look at vehicles relative to when we may want to access them to meet our cash flow needs. And with this strategy, what we do is we allocate relatively lower paying returns that are safe and liquid in the short term. We use stocks in the long term. Stocks have risk, they have higher long-term returns, and in the medium term, we typically will use bonds or annuities, and these are specifically growth annuities. So when we look at how this maps out, in the short term we have CDs or cash on hand. We'll have in a period, let's say 3 to 9 years. In a medium term, we may have bonds or annuities. And for the long term, 10 plus years, we may have stocks. We may cash out the stocks, and we're not looking at just at a dividend strategy, but at a total return strategy of the stock. We may cash those stocks over a longer period of time. When we look at the class of stocks, bonds, and annuities, very interestingly, it looks like the return of all those three vehicles will be fairly similar over the next 5 to 10 years. Stocks and bonds will have fairly similar returns. Annuities will also have fairly similar returns. So when we look at the risk of the different vehicles and their performance, there isn't much difference in the returns. So what may be attractive for investors is to look at the relative safety of those vehicles. So of course, we know stocks have risk because of performance. We know bonds have risk from two standpoints. One is the default risk, which is fairly low. Also, we have interest rate risk. When interest rates go up, the value of the bonds goes down. That is a risk in owning bonds, particularly in the short term. And when we're looking at where the Federal Reserve is looking at their strategies, we may have some increases in interest rates. We believe that they'll be less than they have been in the previous year, but there is some risk in that regard. And we have annuities that are fixed annuities. There's relatively little, almost no risk at all, particularly if you use highly rated annuity companies. When we look at those returns, they'll be fairly similar. The one other difference we want to look at is fees. So stocks and bonds have fees, depending if it's a no-load or a non-managed approach. The fees will be very low. If it's a managed account, there'll be higher fees. And when you use fixed annuities, there are many annuities that have no fees. So the fee advantage goes to the consideration of fees favors annuities. However, the liquidity consideration favors stocks and bonds because annuities have limitations in liquidity. If you have any questions on what we had discussed today, please feel free to reach me. Thank you for listening to the Financial Lens strategy titled Income Strategies for Retirees.